All right, good morning, everyone. It is 9:03 in the morning of March 23rd, 2022, and this is my pre-market strategy session. So, what we have here right now is the E-mini S&P up on chart, and this is the daily chart. So, today, as of right now, if the regular market opened right now, there would be about 0.5%, a little bit more than 0.5% lower than its previous close. And after, gosh, what is this? This is, I think, on the E-mini S&P, it's like a 13%. Let's see, from top to bottom, a 9.33% move in the past 6 days. And you don't get moves like this in bull markets. This is definitely, if this is a bear market rip your face off rally right here. This is to punish everyone who got in down here in this area for the break lower, for the breakdown to go lower, and it didn't work out. And then there was options expiration last Friday, and the retail was heavily bearish. I mean, retail, it was like, I've forgotten, but it was like over 2-to-1 of put options over call options on coming into that Friday's expiration. And let's see, actually, what date was that? Last Friday. Last Friday was the 18th, yeah. And so, let's see, here's the 18th, and I think the volume, let's see, on the 18th, this is the E-mini S&P. Let's look at the SPY here real quick. See what the volume on the SPY was on the 18th. Yeah, here's the 18th. So volume wasn't, I don't know, all that bad. It was actually quite a bit higher on the 16th there. So anyway, retail isn't allowed to beat Wall Street. It's just the way it goes. Those are the rules. Retail is never allowed to make more money than Wall Street. Wall Street, holds all the cards. And so when retail gets out of bounds, when retail gets, too bearish or too bullish, Wall Street will come in and harvest that crop. They will come in if it's too bearish, they will run the market up in order to squeeze all the cash out of the sponge that they can, and then when Wall Street's ready, they'll let it sell off. If people have gotten too bullish, they'll be like, all right, sell it. That's just the way it goes. And that is definitely part of playing the game. How to learn to play the game. When retail gets too long or too short, it's time to step back and let Wall Street do its thing. You don't want to stand in the way. Okay, here we are this morning. Couple things. The economy it's still bearish, and until Wall Street can look past the falling GDP numbers, the falling earnings, and the falling inflation, the inflation cycle has peaked. And so, until once inflation starts rising again and everything's kind of corrected, then we can look for higher prices. But for the time being, it's bearish. Now, with that said, that doesn't mean, what's that saying? The market can stay irrational longer than I can stay liquid if I don't play it right. So this really could be, in my opinion, this is my opinion, and actually my opinion really is only what my hedge fund consultancy opinion is. Really, there's way too much data for me to sit here and digest and make sense of to be able to trade on. So, I hired help. That's the only way to do it, really. And so they are saying that it's still bearish. That doesn't mean, though, that this can't keep going up. That doesn't mean that this move can't keep continuing. Like, suppose for a moment we get a little pullback right here and then keep on head, higher to higher highs. That possibility exists. I seriously doubt it. And the reason that I doubt it is there are a couple things. So even though right now the 10-year, let's take a look at the 10-year. We'll get back to the risk range levels here. So here's the 10-year. The 10-year is skyrocketing here. You see that? And even though the 10-year is just totally ticking off, the 2-year, check out the spread. We'll go to the spread here. We'll go to, take it to the indicators on this one. So this is the 10-year minus the 2-year. I don't know if you can see that watermark. This is TNX minus the US 0-2-year. And here it is down here. The spread is 0.23 roughly. So what that means is if I put my money somewhere for 2 years, I can make roughly, I would only make 0.22 points higher, or actually 229 points, but that's 0.22% more on the 10-year if I lock it away for 10 years. So what would you do? If you're going to lock money away, and it's going to be for a shorter time period, that's what I would do. I mean, it doesn't, a 0.22% gain isn't enough for me to want to put my money into a 10-year over a 2-year. So here it is, and it's getting really close to inverting. So here is the inversion that occurred back here in September of 2019. Now, it just so happened that this inversion came before the pandemic. And here's the pandemic right here. This is where the pandemic hit. So the economy was really headed toward some really rough stuff even before the pandemic hit. When the pandemic hit, it actually kind of saved the market. It actually kind of saved the economy. It gave the excuse for the Fed to loosen dramatically and for there to be a whole boatload of stimulus spending by the U.S. government. Because even before this, or when this started to invert, the economy was looking. There are a lot of things in the economy that just aren't right, and they still aren't right. But the Fed and so on and so on. So the 10-year and the 2-year is on track at the moment. It's on track to invert again. It's not far away, from inverting again. So, once we'll see what happens. We'll see what happens. We've got a quarter coming up that in comps is going to go from plus 7% down to close to 0% year over year on an earnings season. So once this next earnings season kicks off and earnings start coming out much lower than expectations and so forth, we'll see what happens. We just have to wait and see. So for the time being, I'm still looking for. It's been a slow couple weeks for me since roughly the 14th of March. There have not been as many short or bearish setups. And that's the side that I'm playing right now. I'm looking for bearish setups, and so it's been a really slow week for me. It's been a really slow past few days for me. So today again I will be looking for the bearish setups on equities and so forth, and looking for bullish setups on oil and gold. So there are three headwinds roughly. So first of all, rising interest rates, the rising dollar, strengthening dollar, and rising oil. All three of those are major strikes against the economy. They're against GDP, consumer discretionary spending, so on and so on. Money's tightening, the dollar is strengthening, and oil is going through the roof. That is less money for consumer discretionary spending, as well as a whole boatload of other sort of retail, so on and so on and so on. The dominoes just keep falling. So, and tech for that matter, that's less tech spending, so on and so on, which includes Amazon definitely. So, looking for the bearish setups on retail, on the major indices, and looking for bullish setups on oil, gold, and at the moment, interest rates. All right, everybody, that is my pre-market strategy session. Good luck out there. Keep your wrists tight. Click like, share, subscribe, leave a comment, tap the bell, and I will see you at tomorrow's strategy session. I am out.